Now let's talk about another financial statement, this time a little bit more in depth. The statement of owner's equity. We'll also look at an example, but first, what is the purpose of the statement of owner's equity? Well, the purpose is to report changes to owner's equity, which remember is just the capital account. So it reports changes to the capital account for a certain period of time, not a single day. So it's going to be for like a year or a quarter or a month, just like the income statement. So do you remember what the formula is for the statement of owner's equity? It's bind with an E. That's how a lot of students memorize the formula, bind with an E. So what's the B stand for? It's the beginning capital. In other words, the capital at the beginning of the time period, which is usually the year, beginning of the year. And we want to end up with showing what the ending capital balance is at the end of the year. And in between, we show the four things that affect capital. So remember, the four things that affect capital is one, owner investments. So an example of an owner investment is the owner starts a business and puts his or her personal cash into the company's checking account, also called the cash account. So cash would increase and capital would increase. That's why I have a plus here, because owner investments increase the capital, also called equity. And we also learned that selling things, which is revenue, also increases equity. And the two things that decrease equity, also called capital, are expenses and draws. So back to the formula. The first thing we're going to do is we're going to add investments, also called owner contributions, to the formula. Well, notice the next two things on our list of things that affect capital are revenues and expenses. Now remember, the statement that we did before this is the income statement. So the income statement produces net income, which already has revenues minus expenses in it. So for the statement of owner's equity, we're just going to find the net income from the income statement, and we're going to add it here. Now, of course, if the company had a net loss, we would subtract a net loss, because that's going to lower capital. And then the last thing that affects capital are draws, so we're going to subtract draws. So when I say students often use bind with an E to remember the formula for the statement of owner's equity, that's what I'm talking about. B is beginning capital balance. I is investment, add investment. N is net income, you're going to add net income. D is draws, you're going to subtract draws, and that gives you E, the ending capital balance. So let's look at an example of a statement of owner's equity. Notice our formula starts with beginning capital, so the first thing that they have on their line is Bright, comma, capital, so the owner's name must be Bright, November 1st, 2024. Now let's go up and look at the three-line heading. What time period is this statement of owner's equity for? It's for the month of November, so the beginning capital would be November 1st. That's why it says Bright, comma, capital, November 1st. That's another way of saying it's the capital at the beginning of the time period. So notice this company's capital, and the company's called Smart Touch Learning, they started with zero capital. So they probably started their company brand new on November 1st, 2024. So let's get back to my formula. Bind with an E. The I stands for investments. We add investments. What are the investments also called? Owner contributions. So on this statement of owner's equity, we are adding the owner's contribution, also called the owner investment. So apparently, the owner invested $30,000 into his or her business. And then back to my formula, the N in the bind with an E stands for net income. We're going to add net income. And looking at this statement of owner's equity, their net income is $5,300. And then notice we have a subtotal of $35,300. That subtotal is obtained by taking the beginning capital plus the owner contribution plus the net income. Now when you're doing a statement of owner's equity for me, I don't care if you have this subtotal in there or not. It's not really important. The main thing is you have bind with an E, beginning capital plus investment plus net income minus draw equals ending capital. All right, so next, getting back to my formula, bind with an E, the D stands for draws, so we subtract draws. So let's look at the statement of owner's equity for Smart Touch Learning. It looks like the owner withdrawals were $5,000, and the parentheses, remember, means that they are subtracting it. And again, for me, it's okay if you use a minus sign instead of parentheses. So when we take the subtotal of $35,300, we subtract the owner withdrawal, we get a final ending capital of $30,300. The reason we can tell that this is the ending capital is because, remember, for this statement, the time period is for the month of November. So because this is bright capital November 30th, that's another way of saying ending capital. In other words, the capital at the end of the period. So let's analyze this statement of owner's equity. So the main thing is, did capital, in other words, owner's equity, did it go up during the period or did it go down? Well, the beginning capital was 0 and the end of the month with $30,300 of capital. So that's good, equity increase. What's the main reason that equity increased? Well, the main reason is the owner made a large contribution. The secondary reason that it went up is the company has a net income. Now, I'd rather see that the majority of the increase in equity is from net income. However, if this is a brand new company, which it looks like it is, then it's actually very unusual that a company would have a net income, in other words, a profit for the very first month of their existence. So this company looks like they're off to a great start. So don't forget, the formula for the statement of owner's equity is bind with an E, and it's really important that you understand the 4 things that affect capital. Owner's investments, also called owner contributions, make it go up. Revenue makes it go up. Expenses make capital and equity, of course, go down. And draws make capital and equity go down.